Does the large short value of VXX concern you?
I find the heavy short interest in the VXX to be one of the market's biggest risk factors going forward. Let me walk it back a minute. The VIX index, which people mischaracterize a lot, is the average volatility rate, roughly a 30-day average weighted volatility over the next few weeks' expirations. So it's a blended index of where the market expects the volatility to be. That has tended to trade a little bit high relative to historical volatility, which is averaged, let's say, in the 6-7% range, with the VIX sort of in the 9-10% range. But that's been something that people have really been focusing on as well. The market's been displayed such a lack of volatility, and so we're going to keep pounding on that trend, and we're going to keep shorting. People keep doing trades that work. The danger in this case is, danger number one is just being short volatility in general. I think people who don't trade options don't have necessarily the right fear of being short volatility. Those of us who trade options professionally know how to trade from the short side and know the risks of trading from the short side. The problem with VXX is it's a vehicle designed for people who are not really trading the underlying options. It's normal equity traders who are trading in a volatility product. If you're an equity trader being short vol, that may not be something you're used to, and that's yet another risk factor. Another risk factor on top of it is when you get a very crowded trade, such as VXX, such as one ETF being the largest single short interest that we're seeing, outside of, let's say, S&P 500 names, which is part of index arbitrage, let's say. But when you start to see an ETF which is constructed out of derivatives, right? It's actually an ETN. I'm sorry for mischaracterizing it as an ETF. The terms are used interchangeably, but they're not the same. It's basically a credit instrument, a note, not a basket. And to get the desired hedging, basically the sponsor of that ETN has to be out trading the products in the marketplace. So let's follow through the flows here. Someone shorts the VIX. That means VXX rather. Someone on the other side is long. Their hedge would be to sell options into the marketplace to hedge. So that's really that's the transmission mechanism from the equity side into the options market. These long volatility sellers, the people who are on the other side of the retail shorts, or institutional or hedge fund shorts, I shouldn't characterize it as one type of trade versus the other. But someone who's on the other side of these trades then tries to sell the options into the market, and that's what's been keeping the implied volatility so low. The fact that the stock market keeps going up, the fact, which this is ultimately related to, the S&P displays little vol, but it's all one big feedback loop. The people who are long the options delta hedge, which means if you're long options, you're selling rallies, buying dips, which compresses the range. All of that has led to what I would sort of think of as a ever-tightening spring. The question is when and if that spring blows. We saw a little bit of a worry about this a few weeks ago when the market had what I would consider a relatively minor dip of 1% or 2%, and the VIX went from 9 to 15 in about 3 hours. If there is a sustained trouble spot in the market, and we can spend hours talking about what those might be, but if there's a sustained bout of trouble or sustained selling that is, that sort of overwhelms the buy the dips or causes a gap opening, in which case the dips are bought at a lower level, that trade could be very harmful. I find when people really crowd into a short trade, it has a nasty way of working against them at some point. And I wish the people luck who are doing it, but I think it's a very difficult and very crowded place to be right now.